Hi, Adam Gower here. Now, what with inflation still eating away at the economy, interest rates the highest they've been for 20 years, home prices plummeting, stock market reeling, war in Europe, civil unrest threatening the upcoming midterms, it is hardly any surprise that today's guest, John Drachman, co-founder at Waterford Properties, caught my eye on LinkedIn with his moniker, Dr. Doom. John has been talking a lot about what's going on in the economy and beyond on LinkedIn, and today you're going to hear directly from him his take on both domestic and world affairs and how he's preparing to meet whatever challenges lie ahead. To find out more about John and Waterford Properties, go to the podcast page at gowercrowd.com, and while you're there, be sure to click on the subscribe button at the top of the page to gain access to our free weekly newsletter. We're the only website exclusively dedicated to real estate crowdfunding and syndication news and updates, where you'll get information and resources that you can use immediately. Subscribe to Gower Crowd there at gowercrowd.com. It is totally free. Okay, without further ado, here he is, John Drachman, co-founder at Waterford Properties, also known as Dr. Doom. John, well, it's a pleasure to meet you. And I know you asked me what kind of questions I'm going to ask. Well, they're usually very, I shoot from the hip.
Yep.
But I'll start off by telling you what it was that caused me to want to talk to you on the podcast. Of course, on LinkedIn, I love the moniker Dr. Doom. Oh, I do. So I do love that. So you got to start. Just tell me why are you Dr. Doom? And tell me what you're seeing in the market, because I suspect we see eye to eye, and I'm usually too embarrassed to be so straightforward about it. But
yeah, well, anyway. It's funny. Well, thank you very much for having me on the podcast, by the way. And I've told this story. I had a good friend of mine. It was probably about 5 or 6 months ago. We were playing golf. This person's an active developer of multifamily assets. And we were talking, and I was saying, you might want to be careful. I've been doing a bunch of research, and I'm really, the market's getting a little weird here. And I know you're breaking ground on a couple projects in a couple markets where I think, multifamily specifically could see some issues. And we were playing over the course of that round, and I kept kind of harping on him. He's like, "Man, you're like Dr. Doom over here," right? And it was a term I hadn't used since kind of 2007, 2008. I think it's Nouriel Roubini. I don't know if I pronounced that correctly, who, was the NYU professor who was very bearish back on CNBC in 07, 08. And he was sort of making reference to that. And so I'm a guy who likes to have a little bit of fun. And so I told him, I said, I'm going to use that. I'm going to post something on LinkedIn. And, running my own company with my business partner, I have the luxury of not having, a corporate sort of person who oversees me. So I had a bit of fun one day, and I was kind of joking with him. I'm going to post something negative on LinkedIn using the Dr. Doom moniker, and I did, and it's kind of interesting. It's kind of taken off. Where I think I didn't anticipate it to be that way, but I think it's resonated with some people, and kind of away we went. And I can get into sort of why I feel sort of pessimistic on certain markets, but certainly it was something that was just sort of tongue-in-cheek fun, and I kind of run with that.
Well, John, we have to we have to dive into that. I've got a very important question related to that, but I forgot. Of course, I got all carried away. First of all, John Drachman, is that how your name's pronounced?
Yeah,
John
Drachman. Yep.
And you just tell me what your company is, what you do for them. Like, just give a high level overview. Then we're going to ask you something about Dr. Doom.
Perfect. So I'm the co-founder of a company called Waterford Property Company. We're an owner-operator of mostly multifamily assets, affordable workforce housing and market rate housing in California. We're based here in Orange County. My business partner, Sean Rawson, and I started the company. We started partnering together back in 2014. Really, the company came together in 2018. We've done about $2.8 billion of transactions since 2014. And so, and again, we're primarily focused on multifamily. It's kind of our bread and butter. We've done commercial projects, value add commercial projects, retail and office, but primarily multifamily focused.
Now, to rightfully own the moniker Dr. Doom,
Yep.
you must, I have to assume that you know what you are talking about, right? And what I mean by that is this, that you cannot really appreciate what is going on in the market today unless you've seen something like it happen before.
Yes.
And have that wealth of experience that positions you in a way that you can see what's going on and you can talk about it intelligently. What is your experience in real estate that gives you the context for what is going on at the moment?
Yeah, so I started my career in 2003. I worked for a home builder for a year, big public home builder. And I always tell people I hated it. I hated working for a big public company. I'm not a corporate person. And then I switched and I became a commercial real estate broker with Grubb & Ellis out of their Newport Beach office doing office and industrial leasing. Is actually where I started my career. So this was back when Orange County was the epicenter of really the subprime bubble. And so I saw all these companies who were leasing office space in Orange County, companies you're going to remember that some people, younger generation don't, AmeriQuest, New Century Financial, Encore Credit. I mean, there were all these companies that had a huge presence in Orange County office space that I saw, got to know, leased office space too, and remember being like, these companies are garbage. What they're doing is not going to work long term. Felt like a really shoddy business model. So I made the decision in the spring of 2007 to leave brokerage when I sort of thought Orange County office leasing was going to get a little difficult. After having a lot of success at Grubb & Ellis, and go back to graduate school at USC, where I got my MBA and my master's in real estate development degrees. So I was in grad school from the fall of 07. And really, there was a Friday in August of 07 when the credit markets really first locked up. And I joke with people that that Monday was my orientation in my MBA program. So I literally started right when sort of that subprime collusion, which I thought was going to be sort of concentrated in just, Orange County office real estate, sort of was started to spread. And so I was in graduate school, and it was a fascinating time to be in graduate school. I was very fortunate where one of my professors was a professor by the name of Dr. Raphael Bostic, who's now the head of the Atlanta Fed. And he taught my real estate capital markets class in the fall of 2008. And I'll never forget, probably the second or third class after Lehman Brothers had failed the day before, he said, throw away the text. We're just going to read the Wall Street Journal every single day and talk about what's going on in the market. And so I was in school in this really interesting time frame where all these things were happening, right? And it really caused me to sort of really believe that, real estate can have major issues and challenges, right? And that it really shaped me. It also shaped my business partner. And I graduated in 2009 to a very difficult job market, started my career though, finally found a job after 7 months of really painstaking work at the end of 2009, and then rode sort of the wave of distressed deals that were plentiful on especially the office and the industrial side. And so my career was really shaped by the GFC because I was in graduate school and all these negative things were happening. And I really learned a lot and saw a lot. And then it's always been in the back of my mind. So I've always been somebody who's believed that you've got to be mindful of real estate can go up and it can go down. And so I think that really has sort of shaped my career and probably always been in the back of my mind throughout my career.
It's interesting. Before we started, I did date myself, I know, right at the beginning, but when I was first involved in multifamily in the 1980s, and I remember when the savings and loan crisis hit, the bottom fell out of the real estate industry, basically.
Yep.
At that time, somebody said to me, I can vaguely remember I can see his face, I can't remember his name. But he said, when this happens, he said, you might as well just take time off. Yeah. Just take time off for a while listening. Yep. You hit it absolutely perfectly.
Yeah.
You couldn't possibly have done it. So what did you learn during that period, right? So here you are at school, MBA. Oh, by the way, I don't suppose you remember, did you ever sit, it's a bit daft to ask a name, but did you ever see Con Howe of City View? Did he come in and do a little presentation?
I don't remember him, but we had so many interesting speakers. Stan Eisman from American Realty Advisors, Chuck Schreiber, who we mentioned in the pre-call, yes, Chip Fidalin, who at the time was running the commercial real estate loan portfolio for Wells Fargo. And I remember him walking through the merger with Wachovia, and how, I mean, it was just things were happening in real time. So I had a number of people, very smart people, coming in during that time explaining what was happening. And the biggest thing I learned is, real estate is cyclical. It goes up and down, and that you have to be disciplined in your underwriting. You have to be disciplined in your approach, and that you can't think that the markets are always going to go up. And that, it's sort of like there's all these analogies, but there's one I love from the movie Jurassic Park, where Jeff Goldblum's character is talking and he says this line, "Life finds a way," right? And he's talking about, that they'll find a way to make something happen. I always feel like cycles will happen. The real estate gods will find a way to make sure cycles happen, and that it's sort of inevitable. And we spent a lot of time when I was in grad school talking about the RTC days, what happened then, because people were trying to compare the GFC to that period of time. And you just really realize in our business, cycles happen. They're normal. It's a normal function of the everyday economy, and specifically real estate. And so I think that's probably the biggest lesson I learned, is that, in real estate, I say you want to play 65% offense, 35% defense. And that, especially when you saw studying projects in 2006 and 2007, you realize people were being very aggressive before sort of the bottom fell out. I think those are some of the lessons that I remember I learned, is that you got to be disciplined, and you got to know that you can't think the world's and markets are always going to go up, because they don't.
John, so the only reason I specifically asked who taught you, or who your guest speakers were, incredibly egotistical reason for asking, but I actually came in and did some guest lecturing.
God.
You see it at the same time. That's the only reason I asked. So I'm so glad you were so flattering about all the quality of the people that came in. So hopefully, but you can't remember that I came in and do that. That's a whole different thing. So let me ask you this then: when the downturn hit, cast your mind back, all right? Lehman Brothers collapsed.
Yes.
But prior to that, the day that you started over there at doing your MBA, or it's called something else, isn't it? Real estate MBA.
Well, I got my MBA. I got a dual degree, so I got an MBA, and then I got a master's in real estate.
MRE. That's right. MRED. That's right. I remember. Yeah. So before you started that course, and before the crash came, or actually when it came, did it surprise you? Had you imagined this time's different?
So it's interesting. When I was doing office leasing in Orange County, I was dealing with a lot of these subprime mortgage lenders. And I just remember, as a 26, 27-year-old real estate professional, going, this just seems crazy. These people are not that smart to be making this amount of money. I would ask them about their business, and I was like, so you're making loans to people who have bad credit, and they're going to have these balloon payments. What happens if they can't refinance or sell? And it just seemed, it was nuts. I mean, these companies were expanding and doing things where you just went, this is just getting way over their skis. And it seemed way too easy of a business, right? And so, but to be candid with you, when I went back to grad school, I didn't see sort of the collusion of that impacting all the financial markets. I thought it would be susceptible to, certain borrowers, susceptible to Orange County office. I always joke that I went back to grad school thinking the Orange County office market was going to fall off a cliff. I didn't realize the rest of the economy was, but I was certainly nervous. And I think one of the reasons I was nervous is it felt like things were far too easy. Does that mean you would talk to these? I remember I literally represented a company where they took 3,000 feet, then they took 7,000 feet, and then they went to 15,000 feet of square footage of space. And you're like, and these were young guys who neither of them had graduated from college, doing subprime mortgage lending in 06. And I was like, how are you growing so fast? This doesn't something seems fishy here, right? And I to be honest with you, and probably get into this topic, it's probably some of the reasons why, Dr. Doom effectively has kind of come back, because I've that same feeling when I've studied the multifamily market specifically in Sunbelt areas, sort of came across to me where I was sort of like, this seems like something's getting too easy again. And that's when my sort of spidey senses went up.
So that, of course, begs the question.
Yeah.
What is smelling off today? What are you seeing that's fishy today? Let's get into it, John.
Well, I think we started as a company investing in market rate, value add, multifamily projects in Southern California, really at the beginning of 2015. We started buying multifamily projects to rehab them, improve them, increase rents, and really felt like there was a lot of opportunity buying 60s and 70s product in infill locations in Southern California. As we got going with that business and started having success doing that, I come from a commercial value add background. My business partner comes from a development and entitlement background. So we sort of leveraged those skill sets to get into this value add multifamily space. As we were doing that, we started exploring, maybe we should look at other markets outside of Southern California to do this in. And so we started looking in markets, specifically Las Vegas and Phoenix, towards sort of the end of 2018, the beginning of 2019. And when we studied those markets, we were like, these don't make a lot of sense. It doesn't seem to make as much sense to us because the prices are really high. The cap rates were not as much higher as they were in Southern California. We felt like you were buying there were people who were, when we were buying projects in Southern California, we were predominantly buying from people who had owned, really a lot of people who had bought in the RTC days, early 90s to late 80s, early 90s, mid 90s, had owned for 15 years, 20 years, and we're in a position where they said, look, we recognize we're going to have to put a lot of capital into this project. We've made a bunch of money and equity. We don't want to do that. That was the primary seller we were buying from. And it felt justified to us because we said, look, we're going to buy for a low cap rate, but we're going to improve the asset and improve rents and do really heavy value add. When we would go to Phoenix, we had brokers, or Vegas, or some of these other markets we looked into, Denver. It was like, no, you're going to buy a project that's been flipped 3 times already this cycle. Yeah. And it's been half rehabbed already. And so you're going to kind of half rehab it again, and you got to increase rents 20%, but you're not really going to rehab it. And it just felt like a game of musical chairs. And this was end of 18, beginning of 19. I think there's a number of brokers who were in those markets who spent time with us would tell you we wasted their time because we really dug in and just said, this seems kind of nuts. Like, this seems like somewhat of a bubble in terms of where cap rates were really trading for. And then the pandemic hit. And we actually thought, oh, wow, some of those deals that we saw, some of those aggressive buyers, some of those younger operators who are buying really aggressively, they're going to struggle in the pandemic. This is going to be the sort of the shoe that drops in terms of that business. Obviously, we were dead wrong about that. We didn't realize and think that we were going to print, I don't even know how many trillions of dollars that we printed. Who could have foreseen people moving, as much to those Sunbelt markets as they have? And so we were wrong, and we missed that. And those markets got supercharged, right? Really during the pandemic, really end of 2020 through 2021 through the first half of 2022, where that aggressiveness we saw, that pricing we saw at the end of 2018 and 19, I mean, it was like, got crazy. And the really crazy thing that I think has happened is debt got basically, if you look at the bridge fund or debt fund space, it got just as aggressive as it did in 06 and 07. Meaning, if you look at LTVs, if you look at what people were lending on, it was very, very aggressive. The debt coverage ratios, their stabilized debt yields. I mean, we've studied a lot of this, and it got really aggressive. And because LIBOR effectively went to zero, you just saw groups have sort of debt that really supercharged this pricing. At the same time, and this is what I think a lot of people are missing, we have 2 other things that are happening now. You have a tremendous amount of new supply that's getting added to a lot of these markets. It's been slower to get added because of supply chain issues, but developers have really had an abundance of capital and are now building in a lot of these markets. And I don't think people are giving quite the credit to the amount of new supply that's getting added to these markets. The other thing that's happening, we've seen in our portfolio, is you're seeing NOI not grow as much because you're seeing, inflation really hitting operating expenses. And people focus so much on rents. They don't focus on, it doesn't matter what your rents are, it matters what your NOI is. And your rents could be going up 5% a year, but if your operating expenses are going up 8%, it's going to eat away at your NOI. And so all these confluence of things have really happened that when we look at, I think we really feel like for us, it took what we thought was going to be not the smartest time to invest if it was 18 or 19 in these secondary markets, to now, and not understanding how you invest, to now being like, this is a bubble and this is going to pop, and that there's going to be some people who bought in 2021 and 2022 using short-term floating rate debt. We're going to have issues, and they're going to be they're already upside down on their equity, right? And they're going to have issues.
But not just 2020, 2020 and 2021 or 22, those buyers, but even before that, there was a lot of overheating in the market. Let's get doomy about it. Doomy and gloomy.
Yes.
There was a lot of froth in the market, right? I mean, you look at buying assets at sub 4 caps, and now what we're looking at is interest rates hitting 6s, potentially going to 7s. And by the way, I did notice, I regretted it so much. I saw somebody post on LinkedIn, I don't know, 3-4 months ago, and I've been calling a housing market, single family housing market collapse since the beginning of the year. And there's various data that I looked at to do it. It's nothing, not only related to interest. And she said, the market's going to soften, and boldly said, but prices will never come down. And I just wanted to, and I lost it. I didn't comment, and I really regretted not doing that. But what we're seeing already is markets, I saw this recently, Phoenix and Vegas are seeing the biggest house price drops already. I mean, it's not substantial. It's not 20-30% like it was during the global financial crisis, the GFC, but it's definitely the beginning. And with interest rates inevitably going to continue going up this year, what is going to be the impact of that, John, on commercial real estate? Where do you think that's headed?
Well, what's interesting is I actually am less bearish on single family homes. And the reason for that is I think this cycle, the consumer wasn't as aggressive as they were in terms of getting floating rate debt or adjustable rate mortgages. I do think prices are going to come down for sure. The market's clearly slowing, but I don't see the systemic risk on that side, because I think a lot of people locked in low rates for longer periods of time, and there will be issues, there will be challenges, but there was a lot of, I think, single family home prices have risen 30% since the pandemic hit. So if we give back 20% of that pricing, you're really 25%, let's say, that which would be monumental. You're really just giving back some of the fake gains from COVID, right? And in large part, I think the balance sheet on the single family home side, this is me, I think is better able to handle this, because a lot of people, I think I read 81% of people have mortgages fixed rate mortgages under 4% in the United States. So if you don't need to sell, I don't think you will. Now, the difference is, though, and this is where I get Dr. Doomish, is multifamily is the exact opposite, right? I think I read a stat that 83% of all loans over the last 24 months in Phoenix on multifamily assets were basically floating rate bridge debt, which is adjustable rate mortgages, right? That's effectively what some would call subprime lending, right? Adjustable rate mortgages where there's going to be a balloon, right? It's 2 to 3 year debt that was at, interest rates that are rising because of LIBOR and SOFR that are going to be upside down. And so I am much more bearish on that side, because I think a lot of people actually were sort of dumb there in terms of how they finance deals, not believing interest rates were going to rise. And so to me, I think this is going to have an impact on all of real estate. Now, what's so fascinating studying this cycle of commercial real estate is where I think, no cycle's the same. That was the interesting thing for being in grad school. Everybody was trying to compare it to the RTC days. And if you look at the GFC is very different in terms of how it worked, the special servicers, there was no RTC. Where I think this is different is if you think about commercial real estate, most of the time in previous cycles, things have gone up and down together. So when a recession hits, apartments, retail, office, industrial, all sort of goes down, and they all come up together and they all sort of flow together. What's so fascinating now is if you ask people in retail real estate, and I have some friends that are in it, they're like, where was Dr. Doom in 2016 when Prime membership started going up and retail started taking hits? And retail, I'm actually more bullish on retail because I think they've been in a recession since 2016 and are sort of figuring it out. You look at office space, which we've owned and I've been a part of, that has been in a really tough spot since the pandemic hit. And you're going to see some real pain there that it's not indicative of where interest rates are going. That's a tenant demand function. I joke, Adam, you're working from home today and you said you would be in your office. I mean, this work from home environment or hybrid environments, I don't see it going away, and it's going to have a tremendous impact on demand. And that's irrespective of interest rates. You've obviously seen industrial, which has just been crazy. And every time I think it's getting overheated, I hear a new lease comp or a sales comp that continues to blow me away. And in Southern California, we're dealing with sub 1% vacancy, which is nuts. So and by the way, I will never call the industrial crash because I thought that market was overheated since 2018. And got wrong
ever since. So here's one fundamental difference though between the RTC. For that one guy in the audience doesn't know what that is. The Resolution Trust Corporation was set up by the government during the 1990s to clear out the bad banks. In fact, there was a lot of banks, significantly more than during the GFC, the global financial crisis. But the fundamental difference between this downturn and those two was that this one is hopefully a controlled burn. It is by design.
Yes.
Neither the crash, the savings and loan crisis of the early 90s, which was the precedent to the RTC, or the global financial crisis, was meant to happen. No one predicted it. Wasn't a managed burn, if you like. This one is. So where do you think we're headed? How deep do you think the Fed wants to see this downturn go? And what does that mean for real estate investors, both passive and professional like you?
Well, look, I think obviously my view, and I've expressed this on LinkedIn, is the Fed was incorrect not to start raising rates in 2021. They should have slowly started raising rates when I think it was painfully obvious to most people that inflation was starting to ramp up. I mean, you can't have 20% rent growth in a year in a market like Phoenix for multifamily, right? I mean, that's insane. And so I think the Fed is unfortunately using back, old data. And so they clearly missed the inflation issue. Many people did. Many people thought it was going to be transitory, is a word that
it's like slamming the brakes on, isn't it, John? I mean, it's like instead of
now it is
over it, it's like an emergency stop.
Right. And that the challenge is they didn't do the slow break, and they're seeing the wall, right? And so I think now they're putting on the hard brake because they don't want inflation. We've had a massive level of inflation. And it's funny when you think back, I think when you look at these cycles, I think something that's interesting is always hindsight's always 2020, and you look and you go, wow, we printed all this money and people went out and spent it. And of course there was going to be inflation, right? And so I think that's the mistake they made. And then now they're having to backtrack. And so I don't disagree with what they've done in terms of having to backtrack. I just wish they would have done it a year earlier. My suspicion would be, though, and I think you're already hearing this from some of the Fed chairmen, that they're going to take a tempered pause. You've seen the issues with the Bank of England having to step in with the pension funds. I think part of what's going on is them trying to scare the markets a little bit and have people slow down naturally. And I don't think they want to get interest rates above 4.5 or their federal funds rate above 4.5. I think they really want to try to, they want to tell people they're acting tough right now, but I think some of it's rhetoric, and I think that they're going to get to a point where they can't have things completely crash. That being said, I don't think we're going to see them pull back heavily on rates anytime soon. And when you think about the Fed and you think about some of the stuff they've done, clearly, shelter is a big part of it. They want to see home prices come down. They want to see rents come down. They want to see that inflation pull back. And so again, if you bought a project in 2021 using short-term floating rate debt on a 2-year floater at 80% LTV, and you bought it at a 3.5 cap, that cap right now is 5.5, maybe 6. So your equity is gone. And I don't see that. I don't see this where there is not going to be some pain and some people who lose for making wrong bets effectively.
Right.
But I don't see Fed raising rates to 8%. I don't see that. I see the Fed trying to slow things down with a lot of rhetoric, and trying to make up for not slowing the brakes. So that would be my prediction. I mean, we'll see. But that's what I think.
Yes, and I want to ask you about how you approach this, what the opportunities are. But I actually, for the first time, I don't usually do this, but I actually published something on LinkedIn this morning. I couldn't resist. I've been binge watching Barney Miller. You're too young to even remember.
I know who Barney Miller is. Yeah.
In the 1970s. It's awesome. I mean, seriously binge watching it.
Yes.
And there's an episode where one of the characters comes in and does a mortgage calculation for his boss. Yep. Detective Harris actually does a mortgage calculation for Captain Miller. And as he goes through all his calculations, apart from the fact that a 2-3 bedroom apartment in Manhattan was $137,000 in 1979, he goes through his calculations, says mortgage 14%. And he goes through this whole calc. And I was thinking, I remember that. I was here in the early 80s when they were up to 16, 17%. It was mind blowing. And the world went on, right? I mean, it continued. But times are different now because we've become so used to these low rates.
They are.
All right, so John, so what are the opportunities, right? With all said and done, what are the opportunities for guys like you and for passive investors, right? Who are of the same mind that there is, we've not even talked about the impact of the Ukrainian war, the war in Ukraine kind of compounding all these issues. The B of A is a whole different, Bank of England, B of E, is a whole different discussion because that was a policy issue that rattled market. So there's all kinds of things going on that are unstable or destabilizing.
Yeah.
What are the opportunities though for guys like you and for your investors, your passive investors?
Well, so I mean, I think this is the joke I tell people when they hear the moniker Dr. Doom is like, I'm actually a really optimistic person. I try to be very realistic. But, there will be opportunities that come through this for sure. There always are, right? If you look back at, the great financial recession, right? The GFC, that there was tremendous opportunities that came out of that. And there were people who in 2009 and 2010 made some tremendous buys that, in hindsight was very difficult time to invest in, but it was a great time to invest in it. So certainly I think patience right now is really important. I think, for us as a firm, we're being really patient. We're being really mindful. We're trying to hoard cash. We're being really focused on our asset management of our existing portfolio. We have almost 5,000 units. And so we're tracking that, doing everything we can to, keep operating expense lower, bidding out all our contracts, really tracking. Luckily for us, our portfolio in Southern California is doing well. But I think it's being really disciplined and conservative. And what I tell people is when I say real estate is 65% offense, 35% defense, sometimes you have to know when you're playing and I'll give you an example, the Buffalo Bills, right? I think they have a tremendous football team right now. They played a game against the Rams in an indoor stadium in September. They opened up their offense. They were chucking the ball. Josh Allen's a great quarterback. So they were being a little bit more aggressive offensively. They're going to play a playoff game this year because I think they're making the playoffs in Buffalo in December, in January. It's going to be cold. It's going to be windy. They're going to have to grind out a win probably. And so they're going to need to know to play that they can run the ball. They can do smaller passes, not deep passes. And I think their success will be determined by their ability to play tough defense. And that's really where I think sort of, real estate is right now. Now is about not trying to throw the Hail Marys, the run and shoot sort of offense, to use a American football analogy. But I think now is the time to be a little bit more conservative, a little bit more patient, right? Trying to think about how can you do things to put yourself in a position to be successful. So that's what we're doing. But make no mistake, these cycles cause tremendous amounts of opportunity, and they will cause opportunities for us, and they'll cause opportunities for investors. We're very fortunate that we only have, out of the 40 outstanding mortgages on our properties, we only have 2 floating rate debt products that are on 2 commercial projects that are fine because we have low spreads. So we're okay there. We can handle them. So we feel like we're in a good spot. We're talking to a lot of investors, communicating our story. We're doing a lot of research right now, really trying to, I would call it, dig our well before we're thirsty, to use a Harvey Mackay analogy. But I think it's about being patient. And I think it's about recognizing that there will be opportunities that come, but you want to be a little bit patient. You don't want to react maybe right away. Because if you think about the last cycle, there were some people who bought in 08, maybe a little early. But then by 09 and 10, there were great opportunities, but you could have still bought in 11, 12, 13, 14, 15, right?
Well, we called it was known as the falling sword. You buy a falling, it was like grabbing a falling sword.
Yeah, they call it catching a falling knife, right? Where you want to be a little bit careful, especially in some of these markets, like the Sunbelt markets, where you could see some of this distress that's coming because of the debt products that are out there. We still believe, look, we're bullish on Southern California. We're still looking at land. One area we're spending a lot of time is on office conversions to residential. We think that there will be opportunities there as office owners really struggle. And that's what I think is interesting. And that's what I was trying to say is, I don't think this cycle is going to be different because property types are functioning very differently, right? I mean, effectively, office assets have been in a depression since COVID hit, right? And so those office assets, as we get longer into this and as leases come due people are going to be in pain there, maybe before multifamily. And so I think it's about being flexible, and it'll be interesting. So I don't think it's all going to hit at once. So that's a long-winded way of saying, I think patience, being smart, being strategic, hoarding cash, but there will be no doubt there will be opportunities that come of this.
Phenomenal. All right, so I completely aligned on that. This is going to give us, there's going to be some good buying opportunities for those well positioned over the next 18 months, at least deep into 23.
And I think if you're a passive investor, what you should be doing is really, as you're researching and thinking about things, really studying the operators. There will be some operators who don't make it out of the cycle. There will be some operators that take significant hits. So if you were a passive investor, I would really be asking those questions of groups. What is your current portfolio like? Are you just buying this new deal because you need an acquisition fee because you're bleeding somewhere else? I think I've thought about posting this. There's a very famous story about a group in Orange County who, they got really bad and basically created a Ponzi scheme where their deals were not going well in 07. They raised new capital, paid old investors and whatnot. And I feel like as a passive investor, it's being really careful and really studying operators. Operators the last 6 to 7 years, if you bought a multifamily asset, you almost could do no wrong, right? So now it's going to behoove investors to really ask those operators, how well have you done? But that's almost not as important as what's your existing portfolio like? How's your existing portfolio performing? What's going on there? Where's your risk? That's really where I would ask passive investors to talk, because I think past performance isn't indicative of future success. And that's what's really important for a passive investor to think about.
Interesting. All right, good. So you've actually preempted in that answer. We're going to have to wrap up, but you preempted one of my last 3 sign-off questions. Now, I'm delighted that you did because it came so naturally. It's always hard to think about these when I ask them. But my third question, and they're just quick rapid-fire questions, John, is what advice would you give to a passive investor? You've given that advice. Thank you so much. Let me ask you the other 2. The first one is, what are your daily habits? What daily habits these are sign-off questions, right? What daily habits do you have that keep you productive and successful?
Yeah, so the first and foremost is I wake up early and I work out 4 to 5 mornings a week. I think that I have a group of really successful individuals that I met at a gym close to my house about 12 years ago. And I swim 2 to 3 days a week with them, and we do a boot camp. We did a boot camp this morning, 2 days a week. And I think getting up early, working out, is something that my wife will joke with you. She knows when I don't do it or I haven't done it for a couple of days. And she always asks, like when we go on vacation, did you pack your gym clothes? Because she knows I struggle. For me, especially swimming, when I swim for an hour, I get in the pool, I feel like it clears my brain, right? I can think about problems at work and I'll get into a long set and routine. So I'm a real big believer in working out, waking up early. Early bird gets the worm. So that's probably the biggest one. The other one for me really is I read a lot. I try to read online, read the Wall Street Journal every day. I like reading books. So I'm always trying to learn more. I never feel like I know everything. And I'm always challenging my beliefs. So I'll read books that'll be recommended that I think will maybe challenge something I said. And I really want to try to, not follow the herd. So those are probably the two biggest pieces of thing for me. It's getting up early and working out and trying to read and stay in tune with stuff.
All right. So just because we've really got limited time and I've got 10 o'clock coming up, but okay, recommend a book. I'm throwing an extra one in. What do you recommend?
There's so many good books that are out there. I personally, the book that I love is Shoe Dog by Phil Knight, about his story about starting Nike. I think it's an excellent book about entrepreneurship. It's an excellent book about, the struggles of really growing that company. And so anybody who's thinking about doing something entrepreneurial, Shoe Dog by Phil Knight is an excellent, excellent book.
I love that you said that. My son, one of my younger sons, proudly proclaims himself a sneaker head.
Yes.
Yeah. I'm learning all these wacky...
The original term was shoe dog, right? So
really?
Yeah, the original term was shoe dog, and that's what Phil Knight calls himself.
Cool.
So
all right, good.
I thought that was an excellent book.
All right, last question. Hardest lesson learned in real estate. We kind of touched on this, but what would you say has been the hardest lesson?
That real estate can be a hard business. When I graduated from graduate school in the May of 2009, it took me 7 months to find a job. I had to move in with my then fiance and her parents where she was living. I wasn't making any money. I thought I had the world by a string. I had 2 master's degrees from SC. I was really well positioned, and it took me 7 months to find a job. And what I learned is real estate can be a hard business. It can be a fun business, but it can be a really hard business. And so you have to be disciplined to know that, and disciplined in yourself. And it's not always sunshine and rainbows. And that was it was the best thing that could have happened to me, because it taught me that lesson, but it was really hard when I was going through it, learning that.
John Drachman, aka Dr. Doom, co-founder, Waterford Property Company. Thanks so very much for joining me on the podcast.
My pleasure. I had a fun time.
That was John Drachman, co-founder at Waterford Properties, aka Dr. Doom. To find out more about John, go to the podcast page at gowercrowd.com. And while you're there, please be sure to subscribe to the newsletter by hitting the subscribe button at the top of the page. It is the only newsletter in the real estate industry exclusively dedicated to real estate crowdfunding and syndication, where you will get information and resources that you can use immediately, all there at gowercrowd.com. Thanks for joining me, John, aka Dr. Doom. It's a real pleasure meeting you. Keep up the good work of reminding us that, well, while there is doom and gloom, there's always a silver lining. And thank you too, dear listener. Without you, we would be nowhere. That's it for today. Be well, stay safe, and for now, this is Adam Gower signing off.